Subscribe to the channel, press the bell icon, you'll be notified of the latest videos. This is Sage for Kalkine Media, and thank you for joining us for our educational series. Today we're covering what is a merger and acquisition. Mergers and acquisitions, or M&A, is a business process in which two firms merge or buy one another to form a bigger enterprise. Mergers happen when two firms join hands, basically. Such partnerships are most common amongst firms of similar size that recognise the benefits that the other may offer in terms of profitability, capabilities and efficiencies. Merger terms and conditions are frequently amicable and mutually agreed upon, and the two firms grow to be equal partners in the new endeavour. Acquisitions happen when one firm decides to acquire another firm and integrate it into its operations. Unlike mergers, acquisitions could be amicable or hostile, depending on whether the purchased firm feels that it is better positioned as an operating unit of a larger initiative. What is the structure of merging two companies? Mergers should be structured in various ways depending on the connection between the two organisations engaged in the transaction. A conglomerate. This kind of deal is typically conducted for diversification purposes between enterprises in different industrial sectors. Horizontal. In business, a horizontal merger occurs when two firms in similar industries but are not direct rivals unite. Vertical. Along the supply chain, a vertical merger occurs between a corporation and its consumer or supplier, and the corporation intends to consolidate its market position by going up or down its supply chain. Congeneric. This type of congeneric merger arises when two firms serve the same customer base in various ways. For example, a cable operator and a television manufacturer. Market extension. When two organisations sell the same items in multiple markets, they can merge to broaden their market reach. Product extension. When two businesses sell separate but similar items on the same market, they can explore a product extension to boost their reach. What are the intentions behind mergers and acquisitions transactions? One of the most critical elements of the corporate financial sector is mergers and acquisitions. The rationale underlying M&A is that when two distinct entities work jointly, they generate more income than if they worked separately. And the following is a list of reasons for mergers and acquisitions. Higher growth. Compared to expanding organically, inorganic growth through mergers and acquisitions is generally a speedier option for a corporation to obtain more significant earnings. A business could profit from acquiring or merging with a corporation with the latest resources rather than taking on the risk of establishing the same. Synergies. The most common reason for mergers and acquisitions is to develop synergy, making the merged entity more valuable than the two firms independently. And synergies can emerge because of lower costs or more significant margins. Cost synergies are formed through economies of scale. In contrast, revenue synergies are usually made through cross-selling, rising market share, or raising prices, and cost synergies are the simpler to calculate and quantify the two synergies. Diversification. Businesses in cyclical sectors recognise the significance of diversifying their cash flow to reduce significant losses during the recessions in their sector. Obtaining a target in a non-cyclical sector enables the firm to diversify its portfolio and mitigate market risk. Significant market share in a horizontal merger, the new organisation will gain a more significant market share and buy the power to influence costs. Vertical mergers also strengthen market power because of the firm having better control over its supply chain, avoiding external supply disruptions. Tax advantages. When one firm recognises significant taxable revenue while the other incurs tax loss carry forwards, this is referred to be a tax benefit. And this is because purchasing a firm with tax losses allows the purchaser to use the losses to decrease their tax liability. And mergers, on the other hand, are rarely done only to evade taxes. If you like this information, please like, share, comment on the video below. Subscribe to the channel, press the bell icon, you'll be notified of the latest videos. But for more information and regular updates, head to the website, calkinemedia.com. This is Sage here for Calkine Media.